Welcome everybody to another update and webinar on the Dream Exchange. I'm Cecala, the founder and CEO of the exchange. The topic of today is early stage growth companies. So there's a new term in securities called an early stage growth company. There's also the term emerging growth company. So which will also be part of the future of this exchange. So we're going to go over that a little bit today. We have a special surprise guest. We'll be able to have a dialogue about, how early stage growth companies and the reporting and compliance will work. And that's going to be later on. But right now, what I'm going to do to give you an overview for those of you who've not been on one of our webinars before. The purposes of the Dream Exchange I think are quite profound. Our team is really in it to win it. There's a labor of love that is from our whole team, and our purposes are, I think they're true. It's someone once said this. This is the hill I'm willing to die on. So this is what we're going to do. We really want to change capital markets in the United States.
We view this as a real mission to change our society. And the truth is that 120 years ago, you couldn't travel to the store without a horse and a buggy. You couldn't travel interstate without getting on a train. And since that time, well, clearly no one would consider taking their horse to the grocery store. You get in a climate-controlled vehicle. We live in a technological society where we have wireless communication that never existed before. We've changed the way human beings live on Earth in the last 120 years in such a profound way that it's almost difficult to imagine that we're not all thriving and that there are people who are barely surviving. And the reason that innovation came to be is because capital markets supported the most imaginative ideas. We gave our money to things that would expand our ability to survive, and we've all been better off for it. And it is across all diverse marketplaces, across all people everywhere. And we're concentrating on developing markets in areas where the greatest ideas are in fact born. And we want to get them access to the money they need to expand upon that. That's really what the Dream Exchange is all about at its core purpose.
Okay, so welcome back. And hopefully that gives you a little insight, if you haven't been here before, to what we're trying to accomplish. We are a stock exchange in formation. We're not open yet. And we're hoping for big things in 2022. And we're actually making significant milestones. I actually do have a little bit of an announcement today at the end. That is something that we've been working on for quite some time. And it's now completed. And in the next year, I'm suspecting there'll be a lot of announcements of this type. So as we did just now, we went through and we talked about, in the purpose video you saw, what we're creating. And this is of real importance. And when you hear from our future guest today, you're really going to appreciate the magnitude of what we're trying to accomplish. We're creating a national stock exchange. That's something that everyone's familiar with. The New York Stock Exchange, the NASDAQ Stock Exchange, they carry the traffic of buying and selling securities throughout the country for all the companies that you're familiar with. IBM, Apple, Microsoft, Ford Motor Company. Those are all listed securities on national stock exchanges. We're also creating something brand new. It actually doesn't exist. It actually doesn't even exist in the law. So you're going to hear a little bit about that as well, called a venture stock exchange. I think this is perhaps the most monumental, most needed enterprise in our country today, which is a capital marketplace for the small company, tailor-made so that small companies are able to raise capital and have a freely open and trading marketplace for their shares. And not to discount what we're accomplishing, we're also doing it with a majority of our ownership of Black investors. So we will be the first minority-owned stock exchange in the history of the country. And there's a 230-year history of stock exchanges in America, and that too is a fairly historical milestone. So we're really trailblazers in this marketplace, and the capital markets really do need what the Dream Exchange is. So the first discussion is, what is the small marketplace? What does it mean to be a small initial public offering? So let me backtrack a little bit and talk about the terms I'm going to use. So initial public offering, the meaning of that is, there's only one way to trade your shares of stock in your company to the general investing American public. There's only one way to do that, and that's to register the shares of stock with the Securities Exchange Commission. So there's a couple of laws that are very important. One is the 1933 Securities Act, and it doesn't start out very hopeful. In fact, the first sections of the 1933 Securities Act say you may not use interstate commerce to buy or sell stock. So full stop, that's how it starts. So, but it's done every day, right? So how is it done? Well, there's only two ways. One way is you register the stock with the Securities Exchange Commission. You prepare documents, which you'll hear about later, so that your stock can now be sold to the general investing public. And that's the word public in initial public offering. So initial is literally the first time. It's the first time that shares of stock are made available to the general public, the first time they're offered to the general American investing public. And historically, this was very significant. It was an extremely important part of the commerce of the United States. So especially for the small company. So where you see small IPO decline, well, we categorize small as a company that's seeking $50 million or less. Now, that may seem like an enormous amount of money, especially if you're a really small company. It's like, wow, $50 million. But when you have to put this into perspective, and it's relative to what are large companies today. So, for example, Apple Computer is a $1 trillion company. So when you start thinking in terms of large companies, $50 million is a very, very small amount of money by comparison. At one time, however, if you look at this slide, you'll see that the dark blue part of the bar graph was the number of initial public offerings that were $50 million or less. And you see that the majority, overwhelming majority of $50 million and under stocks comprised all the public offerings every year and this data goes back for decades. So you'll see in some years it's as high as 90%. It averaged somewhere around 60 to 70% every year. So the smallest of companies were always the ones so inclined to offer their shares to the public, because it was a great opportunity to raise money, and also once the money had been raised, to have free trading. So afterwards, what they call the secondary market, okay, so the initial public offering, that's the first time. Well, after someone has purchased the shares in a public market, they can resell them. So, and that's kind of the overview of the first way it's done, right? I said there's two ways to go about selling your shares. One is to be a public company registered with the Securities Exchange Commission. The other way is to do it privately. And to do it privately, you have to be exempt from registering your stock. There's about 18 different ways to be a private company that sells its stock. Equally complex. In fact, in some instances, significantly more complex than a public offering. So those are the two ways that it's done. And historically, looking at this slide, most companies seeking $50 million or less, they went to the American investing public with their great idea and their great company, and they sought public support for that company's expansion. So you'll see right around, I guess it's 2000, and the print is a little small on the slide. You'll see there's a tremendous decline overall in new companies becoming public companies altogether. But as you can see, the dark blue part of the bar graph, very, very few small public companies attempt the public offering at all anymore. So this is a significant change in economics in our country. In fact, if you look from 2000 and beyond or before, you can see that this option of becoming a public company was something that people took advantage of regularly. Hundreds of companies, somewhere on average between maybe 600 to 700, as many as 900 companies a year went after a capital raise in the public markets. And now you can see there are very few, and most of them are in the blue, the powder blue part of the bar graph. And that part, something that the slide doesn't show you is that the average size is now in today's market enormous. It's not uncommon for the companies that are going public to be $1 billion public offering or more. So the small marketplace really went into a steep decline right around 2000. It was actually a little bit before that, in maybe 1999, 1998. And there are some very particular reasons for this. We've changed the way we trade stock in America. At one time, there was a trading floor where human beings talked to one another and they haggled. If you recall looking at old movies, one of the favorite movies of all financial professionals from the past is the movie Wall Street. And you'll see there's a floor where brokers are on the floor of a stock exchange. And what they're doing is conducting the buying and the selling of all those stocks. Well, those floors no longer exist. Nearly the totality of stock trading today is done using financial technology over electronic stock exchanges. Now, those stock exchanges were really born in 1997 and 1998. I happened to had the privilege of being part of one of the very first ones. And the name of that company was Archipelago. I was the lawyer for the founders of that company. And that company went on to extremely great success. In fact, Archipelago, well, if you read the documents, it says Archipelago merged with the New York Stock Exchange by 2005. From my viewpoint, really, Archipelago took over the New York Stock Exchange. And my former client, Jerry Putnam, became chairman of the New York Stock Exchange because the electronic mechanical trading environment had taken over the entire way we go about raising capital as well as buying and selling securities. So, by 2005, there was virtually no need for the human interaction on the floor of a stock exchange any longer. Well, with that change, with that financial technology and innovation, there's kind of an unintended side effect. And the unintended side effect is that the concentration now is on how much volume of trading of shares a company can produce. So a very small company, $50 million, will not have the volume of shares traded throughout a given trading year that a $1 billion company will. In fact, a $1 billion company, initial public offering, it may have more trading volume in the first few days of its stock than a $50 million company may have in an entire year. So with that shift, naturally, the way that investment banks and stockbrokers and intermediaries and stock exchanges earn their money significantly changed, and their focus was no longer on getting a lot of good small companies into the marketplace where they used to make money. Now it's on getting a very select few of the largest of companies to become part of the public markets. But the public markets are the American markets. It's where we can all participate. And even though you can invest, and you can invest in the easiest of all ways today, you can get an app on your phone. And by clicking on your app, you can go into Robinhood and buy and sell shares of stock in most of the large companies. Well, the fact is that smaller company has not been customized in a way so as to make it a revenue producing, profitable business for the market structure. So the Dream Exchange looked at this decline, and we really did a lot of research to determine what was the effect. We know that there's these causes, but what was the effect of this on the overall marketplace? So the effects on investors is that, there's a lot of companies that are extremely good companies that an investor really never gets the opportunity to invest in at its earliest stages. Now, imagine being able to buy stock in an early stage of a company that becomes very, very large. Well, if you're an investor, that's generally where you'll make the greatest gains. The expansion of the company, the wealth that you can create from investing early in the earliest stage is amplified the sooner you're able to make a wise investment. So if you don't have access to those companies any longer, well, there's a lot of wealth creation that no longer takes place for the general American investing public. So that's a major problem for an investor. He doesn't get to see the transaction. He doesn't get to see what we call seeing the deal. Another harmful effect on investors is, at one time, a very plausible way to recover the investment was when the company went public. If you made an investment in a private company, you have to hold on to it. Remember, the 1933 Securities Act prohibits the sale of stock. So in order to resell your stock in a private company, you have to go through all of the labyrinth of rules to resell the stock privately. So what does that mean? It means that when you make that private investment, you have to hold it until the company is sold in its entirety, or until it's profitable enough to start paying you dividends and profits. Well, what those dividends, profits, or the resale of the company are customarily referred to as the exit. You've entered the company, you've made your initial investment, it's private, but the investor's question in common parlance is, well, how do I get out? What's my exit? How do I recuperate my investment profitably? Without a public market, the exit becomes significantly more uncertain. You have to hope that the company will be resold to a larger company or some other type of buyout from a private equity firm, or a bigger firm will come along and profitably allow those earlier investors to recuperate their investment. That incentive of going into the public markets with an early stage investment is all but been eliminated today. So only the very best companies are going to get investment dollars, even if they're very good companies that are worthy of getting investment dollars. So there's also some harmful effects on companies, and there's a lot of research on the type of company that could benefit from a capital market, like a stock exchange marketplace. And the smaller companies really do need this solution. But only now the largest multi-billion dollar, or what they call unicorn companies, really conduct an initial public offering. So if you're a smaller company and you're a really good company that has valuable ideas that will expand, but perhaps you're not $1 billion company, you really today have very little hope of seeing your company go public. So when that happens, it puts a tremendous burden on the management of the company, because what they have to then do is they have to privately go out and generate relationships to go raise capital. If you're an early stage company, you're very familiar with this. You could be spending enormous amounts of time on raising your money or managing how you raise private money, which takes you away from the operating of the company, creating the company's expansion. So it distracts the senior management from the core activities of the company. In addition, without the companies getting adequate capital right away, critical employment is delayed. And here's a great example. And this is not just my data. So about 10 years ago, the federal government saw this decline in early stage companies. They said, where are all the small IPOs? And they created a task force. It was called the IPO Task Force. And they did a tremendous amount of research to discover, was this a problem? Should we be doing something about it? What is the value of going public to the company? And it's actually most telling when it comes to employment. After a company goes public, 92% of all the jobs that are created in a company happen afterwards. So prior to the public offering, where you may have a company that has 100 employees, it becomes very difficult to expand and hire people. Well, with a public company, you're actually creating 10 times as many jobs. Well, it's not just because you're creating jobs because that's good for America. Creating the jobs is actually what helps the company to thrive. More people at an easier time with operating it, with really trained professionals across all the areas of a company that come by virtue of its public status. And really, as the Dream Exchange brand, and as you saw in the video, one of the primary things that we're concerned with is that a small company is where innovation is. It's where the ideas and the imagination of the entrepreneur really do make our society a different place to live. And what we don't want to do is we don't want to cut off the flow of investment funds to the most able, the most imaginative companies that have the best ideas. So the effects on companies are very significant, because those small companies, those are the seedlings that will grow into the oaks that become the forest. A good example of what I'm talking about is Microsoft. Microsoft went public in 1986, and their initial public offering was $61 million. They fit squarely into what we're talking about. And I can't even imagine the world without the innovation that would come from personal computing. So when you look at these small companies, they all start out in very similar form. Now, which ones are going to make it and whether you make good investments or not, it's not necessarily something that's a very personal thing. It's not necessarily something a stock exchange controls for you, but it does provide you the access to it. And, the earliest investors in Microsoft, I'm sure, did very, very well. So we want to open that marketplace up so people who do have the better mousetrap have access to capital, and wise investors who are willing to invest and choose to invest in these smaller companies have the ability to expand their investment portfolio and gain some wealth. So having said that, one of the ways that we see that's the main way to solve this is to actually create a customized marketplace. And that customized marketplace is now in a piece of legislation. And this is a great update today. I'm happy to announce, this win. So the Main Street Growth Act is a law that we have been instrumental in working with congressional leadership and their staff in drafting the terms that are in this new law. And we see this new marketplace, a change in the structure of how we will do business for the small company to accommodate them. There's nothing wrong with the large company marketplace. It's just not very accommodating to the smaller ones. So this new law creates a brand new type of stock exchange called a venture stock exchange. It also creates a brand new type of stock, and it's called a venture security. And there are some extremely valuable features to this type of security. One is, by being in that public marketplace, you can provide timely liquidity. What is liquidity? Liquidity is the ability to turn an asset into cash. So the timeliness of that for an investor is crucial. If you invest in a private company and the timing is that you have to wait 5 or 7 years to recuperate your investment, that's quite a long time. If, on the other hand, the company can go public after 3 or 4 years, now you can recuperate your investment. You can sell all of it or none of it for any reason or no reason at all, because you have a public marketplace for those securities. So we've changed the structure in this new law in a way that will create the opportunity for these smaller companies. The other important part, and I'm getting to this and I'm hoping to get to it pretty early. So we're moving along nicely because I want to leave some time for questions and answers at the end. The key to this new marketplace is what we're going to refer to here as transparency. And we have a guest. His name is Stephen Taylor. He is, I would call him one of the consummate experts in what we're referring to as transparency, what the world refers to as securities reporting. How does a company translate that information into investor, digestible, written and numerical data? So what does a stock exchange do? Well, a stock exchange helps the investor to verify how the corporation governs itself. Is there adequate amounts of information so that an investor can be fully informed? Have they created a forecast, and are they doing that in a correct way so that the investor can see what the prospects of the company are in the future? What is the quality of the management team? How well are they described in the written documents? In addition, the exchange itself provides something called pricing validation, so that there's now a publicly quoted marketplace that will validate that the value of your investment is what it purports to be. Whereas in a private marketplace, it's whatever the relationship you can build with an investor and whatever the decision between two people is, rather than an entire marketplace that looks at the price of the stock and says, that's a good stock. I think I will buy it at that valuation, at that price. In addition, it assures compliance with the securities laws. So the stock exchange actually helps this tremendously. And the way it actually helps it is by creating a standard system of reporting that information. So, I don't want to steal any of his thunder, but who we have right now, and I hope he's able to come back in. So whenever, Steve, you want to come back in, there he is. We have Stephen Taylor. Steve has 20 years of experience with U.S. companies on the compliance aspect, like how companies comply with reporting information for smaller public companies. And what I want to talk about today, and we're going to have a little dialogue with Steve in just a second, inside the Main Street Growth Act, there's a brand new term. It's called early stage growth company. So an early stage growth company is a company that ordinarily would have taken advantage of an exempt form of registering its stock. It's called Regulation A or Regulation A plus. So you can currently avail yourself of Regulation A, and you're not in a public market under Regulation A, you're in a private market. You're exempt from registering your stock, but there's so much value that the reporting and transparency in Regulation A and Regulation A plus, that those two types of formerly exempt securities will now be allowed to trade on a venture exchange as an early stage growth company. And it's extremely significant change. We're actually pioneers in this. So the ink isn't really dry on any of these rules. And that's actually why I have Steve here today. And one of the things, Steve, I hope I didn't give too short a shrift to your background, because your background is truly outstanding, and you are, an opinion leader in this area. And what I'm interested to know, and maybe the folks on the webinar as well, can you maybe explain a little bit what you feel is the importance of venture exchanges to the future of our market, and perhaps why you feel that they're a needed capital market change from your experience in preparing information for small public companies?
Absolutely. I like to say that the venture exchange is, in my view, really the missing link in the American capital market right now. And as you hit upon, Joe, so many of these uses for companies needing capital is hamstrung because of the reasons that you gave, a lot of which is liquidity issues, non-compliance with security laws that a venture exchange would solve. And I've been in this business a long time. I've been working with smaller companies for actually 30 years. Before I was on the compliance side, I was in the brokerage industry working with smaller companies and private companies that have capital and so forth. And back then, I heard from investor after investor after investor is, gee, if I knew how hard it was to get my money out of this company, I never would invest it. And this is coming from people who on paper have made 3, 4, 500%, but it doesn't do them any good if they can't sell it. And a lot of, as the SEC calls them, Main Street investors, which are investors who invest for purposes other than their business, which would be, venture capital as angel investors, that sort of thing. They need that liquidity. And because they're investing for the future, regardless of what it may be retirement, it may be for their kids' college education, they would love to get in on these companies, but they also need liquidity to be able to get out. It doesn't do them any good. You can't take your stock certificate and go rent a home or pay your kids' college education. Right. You need to be able to sell it.
Right.
And the venture exchange, especially because, as you said, a lot of the IPOs now are billion, if not trillion-dollar companies that were almost completely funded by venture capitalists and angel investors who can wait around for their money. They don't need it right away. But not every company is a investment for them. I mean, as you ask any of those VCs, they may look at anywhere from 100 to 500 companies before they make an investment. Well, a lot of the other companies would be great investments for Reg A or crowdfunding.
Mm-hmm.
And that's great, but investors are somewhat reluctant to make that investment because they don't have the not only the liquidity but the transparency that people want to see, to be able to know that they're making an informed investment, and also as the company grows and matures, that they have the information that their investment is safe, sound, and making them money.
Yeah, that's a great distinction, and I've never really drawn that distinction in a webinar before. But the distinction of, there are professional investors, they're venture capitalists. They raise money in a fund and then they make the investment. And sure, they can wait because their job is looking for the next investment. They get paid to keep looking for investments. That's their job. But yeah, you're right. The Main Street investor who would ordinarily buy a stock that is not a professional investor, but it's equally valuable, if not more valuable, to the Main Street investor to be able to know that they can recuperate their investment, as well as what you just touched on, all of the resources that are available to a venture capital firm that involve the ability to conduct due diligence and look at the company carefully are not really available to your average early stage investor, private individual. So, and maybe you can talk about that a little bit just in your experience here, which is, the importance that you touched on it, transparency. So maybe just a little idea, because I never really go into detail on this, but, for example, what are the types of companies and disclosures that go into the transparency that make it more enhanced to be a public reporting company, someone who's actually filing public compliant information so that people know what they're investing in? Can you maybe give a little explanation so that there's a little more understanding of what goes into that, and what is it that they have to do to be transparent, and what does that mean?
Sure. As you said, the VCs and so forth, it's their business. They can often pick up the phone and get the head of the company or the CFO or so forth and get information. For the individual investor, it is the periodic and annual reporting that companies do. For public companies, it's ones that file on EDGAR with the SEC and have specific requirements, and that the SEC reviews their disclosure and make sure they're in compliance with those regulations and laws, which is very important because it allows a person to compare apples to apples and oranges to oranges rather than just what some companies feel like disclosing, which unfortunately is the situation for a lot of non-SEC reporting companies that are traded over the counter right now. They essentially just issue what they feel like.
Right.
And their financials aren't audited. And I can't tell you how many times I've seen these unaudited financial statements that do not comply with U.S. GAAP and are missing important disclosures that are at best misleading, and simply don't provide the type of information that a reasonable investor would require to make a informed investment decision.
Right.
That's one of the benefits of SEC reporting, and that's why a lot of foreign companies want to be SEC registrants, because they are the number one regulator in the world, and because the SEC reviews those documents and reviews the initial registrations, that it's considered to be the gold standard of a registration and trading worldwide. I mean, that's why so many Chinese companies want to be traded in the U.S.
Now, and you're bringing up the irony of what we've been talking about this now for weeks. So it's ironic because, right, that transparency, a marketplace where you're reporting the information and people can buy and sell in that marketplace. And I know you're all over this, but maybe you can touch on that because, as needed as this is in the United States, it just hasn't really been born yet. We're working really hard. It's not, and in fact, the good news is the Main Street Growth Act was recently reintroduced to Congress, bipartisan. Representative Emmer and Representative Panetta, a Republican and Democrat, introduced the bill in the House. Senator Kennedy introduced it in the Senate. So we're working really hard to introduce it. But maybe you can touch on the fact that there's another very famous country that recently adopted venture exchanges in its capital markets. Maybe you can talk about that a little.
That's right. I mean, most countries, most of the major economies worldwide have a venture exchange because they know how important it is to nurture these smaller companies and bring them along and then provide senior listings for their senior stock exchanges. Of course, the United States is a glaring example of one that doesn't. Another one was China, but they've recently rectified that. In the span of 2 months, from announcement to actual trading, they have begun trading on the Beijing Stock Exchange, which is a dedicated venture exchange for smaller growth companies. Some IPOs just recently started trading. They have 81 initial listings, 10 of which were new IPOs, with 71 of which moved over from their over-the-counter trading, which was a really poor way to raise money. And they recognized that they needed a fully transparent stock exchange to be able to move those companies to and get better trading. And since that time, it started trading a week ago Monday. Their volume has gone through the roof compared to what those companies were trading over the counter, and so are their prices, because people have a lot more interest and feeling of security trading in fully transparent and regulated stock exchange than they do over the counter. So China has come on board for the exact reasons that you have discussed. The reasons I don't
mean to laugh, but it's the irony that
it's just amazing that here they are, a communist country, recognizing the need to nurture and provide capitalism for their smaller companies to grow, and how important it is to their economy and their creation of jobs.
Well, and interestingly enough, one of their concentrations is innovation. They have a tremendous concentration in creating support for the best ideas. That is, commensurate with. It doesn't always the case that the smallness of the company is necessarily making it, innovative, but it is the case. It is true that the innovation is born in very diverse marketplace. There is no guarantee that just because It's Apple Computer today, that the next computing technology is going to come through Apple Computer. Apple Computer was born in a garage.
Yes.
It's very interesting to me how the concept of the incubator, of the way you put it, I'm not exactly sure how you said it, but the ecosystem of companies from very small in the garage to the next phase, so that they can graduate and expand. How the missing link, I think that's what you called it, the missing link in the ecosystem is the venture exchange marketplace. And it's interesting because I think I'm not sure if I have this slide or not. I do. Good. We can talk about this. So this goes right to what you were suggesting, like what's the process? What is the ecosystem? And I put this slide up in particular, and I'm glad I have Steve on the call with me right now, because what you see on the slide now, everyone, is there's a box, that thin blue line, that's really inside a stock exchange, okay? And a stock exchange is merely a set of rules by which the buying and the selling of the shares take place. But before the company gets inside, and before the investor is inside participating in the exchange, well, there's preparation. There's the outside. You see the company's outside the box initially, right? And so is the investor. Well, what the stock exchange and the SEC are trying to do is to create the transparency that's needed to get in the box. So if you don't have compliant financial statements and you don't have an adequate set of disclosures, as Steve was just describing when he talked about the over-the-counter market, he and I have talked about this before, where people believe that over-the-counter, which is a company that has actually registered its shares with the Securities Exchange Commission, they're not on a stock exchange. That's why they're called over-the-counter. If they're not listed and traded on a stock exchange, and it's a wild west of what that company is reporting to its investors. So once you have a stock exchange structure, you now have the security, not to quote the word security, but that's literally what it means. What's the security? How do you know that the company itself is providing an adequate amount of information so that when it's being purchased by the investing public, that it is not misleading them, that it is not providing, a dog's breakfast, if you will, of, what data they picked and chose to give versus what are the rules that say you must tell the truth and must tell the whole story. So as they get inside the box, then there's another series of due diligence. I think this is perhaps even where Steve, to give you kind of a plug, once they're in there, professionals like Steve are the ones who can actually help the company pass through that keyhole, which is you really want to get to the point where on a regular basis, you're reporting the correct information. And let me even say it this way. I think there are a lot of companies and a lot of small investors who just really aren't experts in the market. So there are bad actors. Clearly there are bad actors. There are people who intentionally do wrong things. I think there are a lot of other people who just don't know. And they don't have a professional like Steve in their environment to guide them through the process of making sure that all of the statements are prepared, that everything is adequate, that it's given to the SEC, that it's put in the Edgar system, okay, which is the system that the SEC controls. Once it's in the Edgar system, now it's made available to everyone. So if you want to go check out the company, you don't have to trust looking at Google. You don't have to trust, hunting and pecking for information. Once through the keyhole, now you're in what's called an auction market. And that compliance is being done on a regular basis. It's the initial offering documents, as well as once this liquidity is happening, once shares are being bought and sold on a daily basis, there's periodic reporting. And that's kind of where Steve really comes in. I think a lot of his expertise is probably squarely on making sure that those companies get their compliance on a regular basis. I mean, maybe Steve, I don't want to steal your thunder, but maybe you can talk to that a little bit, which is, it isn't just arriving. The destination isn't, now we have registered shares. After that, you want to continue to keep the confidence of the investors up, right? So, what are some of the features of having professional investor advisors like yourself to keep that there. Some of the benefits of what you do, maybe you could explain a little bit why that's so important to keep that regular gold standard reporting up.
Exactly. We often say in this business that the two best days for a company in terms of stock price gains and so forth is the day, and this is not IPO companies, but say existing companies that have traded stock, either crowdfunding or Reg A or used Reg D or one of the others, and have perhaps gone public and are trading over the counter. Their two best days are the day that they announce that they're going to start being an SEC registrant and register the stock, because suddenly you have a very small number of people who are willing to buy over-the-counter companies that are not SEC registrants. But suddenly you become an SEC registrant, you have an enormous pool of people that are willing to look at the company and buy the company. And then their second best day is when you announce you're going to become listed on an exchange, because then you have even further liquidity and further expansion, and exchange listed companies have much higher valuations than non-exchange listed companies. And that's extremely important for smaller companies that need that exposure, and the fact that we don't have a venture exchange, that's missing.
Right. Yeah, and that's the importance. I love having you on. It's like it's a love fest.
But it's true. I mean, these are facts. I mean, these aren't opinions. These are absolutely factual observations that we can prove with plenty of studies and so forth. This is the fact. Once you become on an exchange, you really need to keep that going and make sure that you're in compliance and that you don't lose the confidence of your investors by falling out of compliance. So that's where I do my business, is both registering with the SEC and then ongoing compliance to make sure that my clients remain in compliance with the regulations, and they're providing investors on an ongoing basis what they need to know, and don't run afoul of the SEC and lose the confidence of those investors, because especially with smaller companies, if you stumble, sometimes investors aren't willing to forgive as quickly as they are, say, a Google or Microsoft that may make a reporting error and not include something. It's much more important for smaller companies to make sure that they toe the line and that they remain in good standing, both with the regulators, SEC, FINRA, and so forth, and the exchange, and that they also provide the investors, and investors don't think that they're trying to be misled.
Right. And actually, the importance of what you're saying, and I want to make sure that everyone really understands this. It's a two-step process. Now, a lot of companies do this, the big companies especially, they do it simultaneously. They register their shares with the government, with the SEC. But registering your shares doesn't guarantee that your company will be accepted to be listed and be part of a stock exchange. So this distinction, I want to make sure that it's a bright line distinction, that, if you fall out of compliance with your securities reporting and you're an over-the-counter company, no one cares really. The SEC might care. You might get in trouble at some point. The SEC and FINRA, they may decide that they'll look into you to see if you're a bad actor. But if you are part of an exchange and you fall out of compliance, well, now you're losing the opportunity potentially to have your shares be traded every day. The power of the stock exchange and governing how the game inside that box you see in the slide is played is extremely important to the transparency and integrity of the market, because the exchange, they can halt trading, they can penalize you, they can delist you, you can come off of an exchange. This happens at the New York Stock Exchange with regularity, and the NASDAQ, where a company falls out of compliance with the rules and the company can be delisted. You're no longer on the New York Stock Exchange, which you said is the second best day in a company's, in its process. Well, gee, would you want to have to lose the second best day milestone by being delisted? And
Yeah, that becomes the number one worst day in these companies' lives, and it's really true. And that's and certainly the worst day for investors because they lose an enormous amount of their valuation. I mean, the valuations between a listed company, well, there's valuations between an SEC registered company versus a non-SEC registered company is a huge gulf, and then the valuation between a listed company and a non-listed OTC company is also huge. Right. I mean, the valuation for an exchange-listed company that registered with the SEC is much greater than one that is not registered and trades over the counter for exactly the reasons you just said. There are things to comply with, and people expect that compliance and have a greater confidence in the company and their investment when those are in place, i.e. registration, SEC compliance, and exchange.
Right. If they can get inside that box and become part of an exchange, it really is a tremendous boost to their value and also to the investing confidence and to liquidity. All those harmful effects that we talked about earlier are mitigated in this process to a great degree. In some cases, they're eliminated entirely. So yeah, it's just so it's such a pleasure to have someone else because I'm usually the sole preacher in the church, and it's funny that you're mentioning it that way because you're right. The need to maintain the transparency and keep the regular reporting going is such an important feature of what we are producing by the venture exchange legislation because the second best day. I mean, and it isn't like a boat. I had an uncle who once told me, the second best day of his life was the day he got his boat, and the best day was the day he sold it. In this instance, it doesn't work sequentially that way. It really does. That's why they have the ringing of the bell and the celebrations that they have because it's an immensely valuable milestone for the lifespan of a company, which many of the companies we're talking about, some of them have been around more than 100 years. And that's the whole point of this exercise. The Dream Exchange, our intention is to see the Dream Exchange become a part of the American fabric for many decades to come, where the things that we're pioneering today will become the rules of tomorrow to make the investing process and wealth creation and job creation something that we can all be really proud of. I want to make sure I don't lose my track of my opportunity to field questions. So we're kind of coming up on the end. I don't want to go past an hour, but we probably will with some questions. So first of all, Steve, thank you so much. I'm really grateful for your time. It's always fun to talk to you because I really look forward to it. Steve's going to be part of, what we're doing in terms of creating what it looks like to go through a process inside the box at a venture exchange. I think his viewpoints and his ability to help solve some of these problems is tremendous. He's a tremendous asset to what we're creating. And I just want to make sure I thank everybody before we conclude and take questions. But a lot of questions are always, how can we participate? What should we do? And how do you stay up to date? So here's what we're doing. You can go to our website. We have all of our social medias there. Our website is dreamx.com. You can see it up on the slide. We have a kind of a social media platform called DreamX Connect. If you want to participate, really, I encourage you to go put your identity into DreamX Connect. If you're a small company, there's a lot of menus. It's not exactly Facebook, but it's a menu-driven environment where you don't have to think very hard. You can kind of pull down the menus and answer questions about your company. If you're an investor, you can create a similar profile. So if you create profiles, and then it's a social media, you can message each other and create a community. I think we have close to 2,000 identities in DreamX Connect already. And we haven't really concentrated on growing it at all. And this year we probably will spend more time expanding DreamX Connect. You can also go, if you go to our website, or you click on a link that I think is in the webinar. It'll take you through in our website. You can connect to DreamX Connect. You can find out more about the Main Street Growth Act. You can email us at info@dreamx.com. We answer every question. We get back to everybody who's got a question. Sometimes I get more detailed questions on the webinars than I have time to answer. So if I don't answer your question, don't be offended. We will absolutely get back to you. And let me just look here, because my team has been trying to summarize, because we get a lot of questions. Let me see. Oh, great question. So there's a question from a Canadian startup, and they want to take advantage of getting on a venture exchange. Is it only limited to U.S. companies? The answer is technically no. You would probably have to create a U.S.-based entity, but there are a lot of Chinese-based companies that have come to the American marketplace because of the, like, as Steve alluded to it, the gold standard of reporting. There's more onerous reporting requirements in some instances, but we don't intend to preclude a foreign company that, if you're totally non-operational in the United States, there may be different considerations, okay? But if you have a presence or a footprint that we can do a cross-border listing, I see no reason why. There's no preclusion in the law that I'm aware of that says, oh, you're totally prohibited. There are other regulations that may prohibit you from doing so, but we do have every intention of creating. The world has become a global marketplace, so we're welcoming all comers, and our goal at the Dream Exchange is always to look for solutions as to how we can do something that's appropriate and helpful, rather than to tell you the 10 reasons why it can't be done. So the answer is initially yes, but remember, the ink isn't even dry on the Main Street Growth Act or venture exchange legislation, and we're actually penning how the rules of the venture marketplace will work as we speak. So these are things that are going to come up, and we'll cross some of those bridges as we come to them. But yes, the short answer is yes. We would be interested in trying to work with you as a Canadian company. Let me see. There's another one. Reporting requirements are often too expensive for small companies. How does the venture exchange be both compliant and viable for smaller businesses? That's a great question. We've actually outlined the overall cost structure in many different ways to lower the bar of the costs, so as to make it more accommodating to a smaller company. Historically, a go public equation, it generally runs in the, if you're going to go into a national market and you're going to be listed on a national exchange, the bare minimum actual dollar cost can approach about between $600,000 and $700,000 if you do it cheaply for a national exchange listing. And then you're talking about intermediary fees and investment banking fees on top of that. The overall cost can approach 17 to 20% of the amount of money you're trying to raise. So that becomes very prohibitive for the smaller companies. Now, because of the early stage growth company portion of the legislation, we've been able to shrink that down, and we've done a lot of analysis. We've given some of that analysis to the Securities Exchange Commission, to where we think the actual dollar costs, which can sometimes be absorbed through the offering, and it's a very interesting analysis, but we think that can be done for about $125,000 to $150,000. Now, that may even seem like a lot of money if you're only, if you're a crowdfunder and you're trying to raise $1 million, that's just prohibitive, right? But when you think about the sizes of Regulation A, which could be, $10, $15 million of capital raise, $150,000 in actual dollar cost is extremely nominal. The other feature that's much smaller, in fact, and as the marketplace develops, we're going to be developing more really quality professionals like Steve, where you're not necessarily approaching Price Waterhouse, where the initial fees to just approach a firm like Price Waterhouse are prohibitive for a very small public company. Well, there's a vast number of intermediaries and qualified professionals and consultants, and we're working with different arms of those people right now to help develop and streamline how they can earn a really good fee while simultaneously having the the cost be significantly less than it has been in the past. So we're actually working on that right now. The initial analysis that we've already provided, I guess it's not confidential now, but we did some analysis, gave it to the SEC, and in the neighborhood of including the intermediary fees, investment banking fees, et cetera, for the small public offering, it really doesn't eclipse more than a total of 5% of the amount of money you're going to raise, which is an extremely cheap amount of money when you consider that the small public offerings of the past generally ran between 17 and 25%. So yeah, we're really streamlining it.
It's really incredible that's that the old 17 to 25, which I can say is absolutely true for a lot of those, and absolutely bringing it down is really important. And I think that the costs are certainly important for a lot of companies, but also I think that there's a lot of misunderstanding of how much being a smaller public company actually costs. I mean, especially for existing OTC traded companies to convert to an SEC registrant is actually could be under $25,000.
Right.
And ongoing is sometimes less than what they're paying OTC markets for their so-called services.
To be in the soup, as we like.
Yes, to be in the soup. Actually, to be an SEC registrant can cost them less than what they're paying for OTC markets right now, which sounds amazing, but it's true. If you find the right auditors and the right consultants, you can actually do that. And then you're well positioned. So when the venture exchange bills come, and I say bills because it will be more than just the Main Street Growth Act,
yep,
and the Dream Exchange gets trading, they'll be ready to go.
Yeah, that's excellent. And actually that's an important point to make right now, which is if you're interested, you need to start now. It's a process. You don't want to wait. The Main Street Growth Act has a very good chance, I think personally, of becoming a law in 2022. You don't want to wait until the bill is passed to start considering what are the things you need to do, because as soon as it's passed, then you may have another 9 months or a year. If you begin preparation now, by the time the bill passes, you're working with professionals like Steve to get your listings over to the exchange. I think that's going to be a very important kind of seeing around the corner as a leader of your company heads up, so that you're preparing yourself earlier. That there's no better time than the present to start preparing yourself. So the other question that we have is the venture exchange only going to serve registered OTC companies or companies that have not yet registered? Yeah, the answer is that there may be some OTC companies that decide to migrate to the venture exchange marketplace. I think that's a certainty. But the answer to that is absolutely not only OTC companies. We are here to generate new listings of new companies that are really pioneers, and we're willing to work with anybody to get you compliant so that you can eventually list. Now, that's actually really the primary purpose of these webinars, and we're going to start changing them up a bit with more input from Steve and people like Steve, that we're going to try to deliver, in fact, more educational seminars that are a bit more precise and telling you what are some of the things you need to look at. What is an independent audit? What is an independent audit committee? What does your board need to be comprised of? Actually, if you want to, as kind of a last plug, there's a white paper that I've written with our director of research. It's called Low Visibility Markets. Low Visibility Markets Acting as Stepping Stones to National Exchanges. It's in Oxford University's Handbook on IPOs. It's chapter 9, and it's become an internationally recognized publication because we're telling you what the characteristics of the company that succeeds are in that paper. So those are really advanced notice. Look, if you have these characteristics and you're developing this in your company and you have these features, you're more likely to succeed in the venture market, and then from the venture market to graduate to a national exchange. So I encourage you to look at the paper. I also encourage you to talk to Steve. I don't know. I'll go back to the slide where you can reach him. We put up his LinkedIn. I think he's really good at being responsive on LinkedIn, and you can connect with him there and get some information. Actually, and then finally, we have a specific question for Steve. Is whether do you work with companies that are outside of the United States? Good question. I mean, maybe you could give a short answer, and then you can, whoever you are, you can connect up with Steve to get more specific answers to your questions.
I do. In fact, a very large percentage of my clients historically have been Canadian and who want to access the U.S. market. But I've also worked with other foreign bodies, companies in other foreign jurisdictions as well.
Okay, great. Well, and I'm looking now. I'm looking at the whole chat. I never want to pass mentioning this. I really do appreciate. I'm getting thank you for the insights and the thank yous. Really, because it really is. Right now we're still in the very early, company stages. Well, not really. I mean, we're probably going to be applying for our exchange license this year, so we're a bit further along than ever before. But this has certainly been a tremendous labor. I really appreciate it on behalf of my whole team that we are being acknowledged for really trying to do the right thing for the capital markets and to really help companies and help entrepreneurs and help the American investing public, because and sometimes the best pay we get at the end of the week is someone acknowledging, hey, good job. Thank you for trying your best to help everyone. So I'm going to go back really quick. Let me go back to the slides here just to make sure everyone gets a good shot at there's Steve. So Steve, is that the best way? Go follow you on LinkedIn.
Yep. From LinkedIn, they can contact me. It's a very easy way to contact me, and then I can give them additional contact information from there rather than
and I know, because that's why we do info@DreamX, because sometimes the email doesn't need to come directly to me. We have, we're up to 17 staff, and we can just send you right to the exact person that you want to talk to. So I want to thank everybody for the time. We went over time, but I always seem to go over time. And I really do appreciate you giving us an hour of your time on a Thursday afternoon. I hope you're all well. I hope you're prosperous. Steve, I really want to thank you very much for coming on and providing the insight that you have. It's very unique. We're going to do this again. And the final word I want to say is I usually end with, how different ways to participate, et cetera. And in the past, we've gotten a lot of people, every webinar, actually everywhere I go, I'm constantly asked, how can I invest in the Dream Exchange? Well, unfortunately, fortunately and unfortunately, there's no longer an opportunity to invest in the exchange. We've actually closed with a very large capital provider. So we've gotten a fairly sizable first tranche of our capital in. And so we're no longer, there's no longer the ability to take advantage of investing privately in the Dream Exchange. But I do want to thank you for any interest that comes that way. I know I get those questions every time too, but it is a very major milestone in our future, because I think that we've got really good capital partners now, and that will carry us all the way to the finish line to opening our exchange in the near future. And we'll be talking about this as the Dream Exchange operational rather than what we hope to be when we grow up. So again, thank you all. I hope you're well. Please stay healthy and well and safe. And I hope you have a wonderful weekend. And if we don't talk to any of you folks before Christmas, I hope you have a wonderful holiday season. And like I said, thank you again, Steve. And we hope to see you all again very, very soon. Stay well and come prosper with us best in any way that you can. Thanks, everybody. Have a great one.